Which one of the following statements is most likely to be true if a seller extends credit to a purchaser for a period of time longer than purchaser's operating cycle? The seller. So can you just tell me the answer for this? So which one of the following statement is most likely to be true if a seller extends credit to a purchaser for a period of time longer than purchaser's operating cycle? The seller, that means there is a seller, a wholesaler, and there is a retailer. Wholesaler, retailer. So which one of the following statements is most likely to be if a seller extends credit to purchasers? So wholesaler has given credit to retailer for a period of time longer than the purchaser's operating cycle. The seller. Next, tell me.
Um,
So what is
Option
happening
B.
is seller is extending purchaser for a period of longer time. See what happens from the time or date when they buy the inventory and sell it and collect the money. That point of time is called as operating cycle, right?
Yes.
So if the seller is giving more time, longer time, so they are financing more than just the purchaser's inventory needs. Right? And what about this? Can be certain that purchase, if they are certain, then why are they going to extend? So can be certain that purchaser will be able to convert inventory into cash
Convert
before
them.
payment is due. See, there is no guarantee that the purchaser can sell the entire goods, right? Seller cannot have that guarantee. Will have a lower level of account receivable than those companies whose credit period is shorter than the purchaser's operating cycle. So seller who is extending longer credit will have a higher level of receivable than a firm with a short credit period, correct? So we'll have a lower level of account receivable than those companies whose credit period is shorter than purchasers operating cycle. What do you mean by this? See, if they are extending credit period, they are having a like more higher level of receivables, right?
Yes. Okay.
Than some firm which has a shorter credit period. Has no need for a stated discount rate or credit period. See what happens if you give discount, that will accelerate the payments. But here we are speaking about extending the credit. So what goes in the favor? This one.
Option A. Okay.
Yeah. Question number 2. The one item listed below that would warrant the least amount of consideration in credit and collection policy decisions is. I think the one item listed below that would warrant the least amount of consideration in credit and collection policy decisions. I think quantity discount given. If you give them discount, they'll make the payment early, right?
Yes. Right. Lower amount they'll pay earlier.
See, first of all, the one, see what happens. The one item listed below that would warrant the least amount of consideration in credit and collection policy. See, if you give discounts,
Discount.
that means you
Yes.
are making them to make prompt payments. Of course, you don't want to give them credit, correct?
Yes, sir. Right.
They can buy the quantity in bulk and they can give you the money immediately. So
Yes.
quantity discount is an attempt to increase sales by reducing the unit price on bulk discounts. It concerns only the price term of an agreement, not the credit term, and thus is unrelated to credit and collection policy. What about cash discount? If you are giving cash discount, you can get you can you can collect more amount from receivables. So this is after selling. This is during before the sales, correct?
Okay.
This is also related to collection policy. This is also related to collection policy.
Yes.
Third question. Can you do this? Can you just read this
Yes.
and try to solve? So Clausen Inc. grants credit terms of 1/15 net 30. That means 30 days the time is given to make the payment, but if the payment is done in 15 days, 1% more discount will be given. Do you understand this one?
Okay. Yes, sir.
Yeah, so in 30 days they can make the payment, but if they make in 15 days, 1% additional discount. And the
Okay.
project's gross credit, yeah, and the project's gross credit sales for the year of this much.
2
So
million.
Clausen Inc. grants credit terms of this much and projects gross credit sales for the year of this much. That means this much credit sales they have done. Credit manager estimates that 40% of customers pay on the 15th day, 40% pay on 15th day, 40% on 30th day, and 20% on 45th day. Even they are crossing the 30 days. Okay.
Okay.
So more than 30 days, 40 and uh, 20, and less than 30 days, 40% of the customers pay. Correct? Hello?
Yes. Yes, sir.
Yeah. And
Yes, sir.
assuming uniform sales, 360-day year, what is the projected amount of overdue receivables? So, first of all, how they are making the payment? So, the payment you are supposed to receive is 2 million, right?
Yes, sir.
So, of this, 30 days, 40% on 30th day. Okay, sorry. 40% customers pay. Okay, 40% pay in less than 50 days, 40% on 30th day, and 20% after 30 days. Sorry, I was like wrong in my estimation. So 20% of the people pay after 30 days. So those are how much? 4 lakhs. Correct?
Yes, sir.
These people are taking more than 30 days to pay. This is already overdue. Overdue, right? So average collection period for these sales is 45 days, as they said. Okay. Overdue receivables will be how much then? Overdue
Mm.
receivables. 4 lakh is the credit sales we have done. And they are saying what is the projected amount of overdue receivables. They are asking, assuming, see, you should understand this question very properly. I will tell you the meaning of this. So this is what is the overdue amount, right? We are supposed to receive. They say that uniform sales are happening in a year. So first, you should understand that everything is happening uniformly. So 4 lakh divided by 360 is how much? We'll get 1 day sales. How much? Tell me.
11th, 1111.
1100.
11.11. 11.
11.
1.1.
uh, uh. So this is the per day receivables based upon this. Correct or wrong? 4
Yes, sir.
lakhs which you are supposed to receive. If
Right.
this is for per day receivables, what is the 45 days receivables? What's the amount?
4,995.
No, that is 50,000, right?
Yes.
Just make a note of this. We'll move forward. Understood, now?
Yes, sir. Yes.
Yeah, sales are
Thirdly,
happening. The uniform sales means the sales accrue evenly throughout the year. That means per month sales we can find out, multiply with per day sales we can find out. We can multiply with number of days.
yes, sir. Done. 45 days.
Yeah, 45 days. This is the overdue period, right? More than 30 days they are taking.
20% is okay. Is done. Done.
Yeah, more than 30 days they are taking. Yeah. Next,
Hmm.
just read this.
Established functions.
An established firm sells computer hardware, software, and services. Firm is considering a change in its credit policy. It has been determined that such a change would not change the payment patterns of the current customers. To determine whether such a change would be beneficial, firm has identified the proposed new credit terms, the expected additional sales, the expected contribution margin on the sales, the expected bad debt losses, and the investment in additional receivables and the period of investment. So what they have done, they sell these items, what we have underlined. Firm is considering a change in its credit policy. Okay. Uh, and with that change, what is going to happen? Uh, like they have seen that such change is not changing the payment patterns of the current customers. Okay. Still they are making the payment in the same way. To determine whether such a change would be beneficial, firm has identified and proposed new credit terms. The expected sales, contribution margin on sales, and bad debt losses, and investment in additional receivables, the period of investment. What additional information, if any, does the firm require to determine the profitability of the proposed new policy as compared to the current credit policy? I would say opportunity cost of the funds. Correct? Whenever you are deciding for any of the policy making, you will always you will see the opportunity cost or not. That means I'm going into new policy when compared to the previous policy. If the new
Yes.
one is better to me than previous, then only I'll go for the new one, right? That means
Right.
I'm seeing the opportunity. That's right.
Yes.
So if I am leaving the old policy for the new one, that means this is the better one. This is not the better one. So I'm
Yes.
losing the
That's
opportunity of earning from this old policy. Yeah. Next question. So a firm averages 4,000 in sales per day sales, and is paid on an average within 30 days of the sale. Okay, firm average. So they have to get this much per day basis. Okay, where they are doing this much sales on per day basis. So a firm averages this much sales per day and is paid on an average within 30 days. That means 30 days is what the people take to make the payments to them. After they receive their invoice, 55% of the customers pay by check. Okay. And while the remaining 45 pay by credit card. Approximately how much would the company show in account receivable on their balance sheet on any given date? So what would be your answer? First of all, 4,000, right?
right.
Into 30 days.
Mm-hmm.
So 4,000 is the sales per day on an
But
average within 30
I'm
days
not.
of sale. Speed on so this is what you are supposed to receive, right? 1,20,000.
1,20,000. Yes.
Whether they pay through credit card or they pay to check, what doesn't matter, but they pay in 30 days only,
Yes.
right? So 1,20,000. Next,
Okay.
just read this. Just a second.
Okay.
Hest Computers believes that its collection cost could be reduced through modification of collection procedures. This action is expected to result in a lengthening of average collection period from 30 to 35 days. So what they do is collection cost can be reduced through modification in this. The action is expected to result in a lengthening of average collection period from 30 to 35 days. Okay, that means it's like they see, it seems that they're finding it difficult to collect, so they are going to ease the collection policy. They believe that, see, it's not always, they believe it, that the collection cost could be reduced through modification of this collection procedures, and they are taking an action for that case, and the collection period is lengthening from 30 to 35 days. However, there will be no change in uncollectible amounts. It's going to be the same, or in total credit sales. It's going to be the same. And furthermore, the variable cost ratio is 60%. You know what is that I'm speaking. Opportunity cost of a longer collection period is assumed to be negligible. The company's budgeted credit sales for the coming year is this, and the required rate of return is 6%. To justify changes in collection procedure, the minimum annual reduction of costs using this and ignoring taxes must be what? See, first of all, 30 days was there, right? Now you have made it 35 days. So how many days extra?
5 days.
5 days. So if at all I see 45 lakhs is my sales for year by 360, my per day sales is what?
1,25,000.
1,25,000, and 1,25,000 into 5 is 5 days sales will be
6,25,000.
so my average balance of receivables will increase by how much? Increase by 6,25,000, right?
25,000.
So and you know, like my average receivables is increasing by this much, and variable cost ratio uh, is 60%. Fine, whatever my sales are, uh, my receivables are this, right? My sales, credit sales of this 60% is what my variable cost.
Yes.
Just tell me the amount.
3,75,000.
By variable cost, and the return required rate of return is how much they say?
6%.
6%. So I want that that should be my return, right?
Yes. Then or equal to 6%.
So just a second, 3,75,000 and the required to justify changes in collection, the minimum and reduction of cost. See, whatever is the required rate of return, that is also that is called the cost, correct?
Yes.
Cost is return that you should always be trying to, recovering.
Yes.
So into
Yes.
6% is how much? 22,500. So this much you should try to recover. That is the minimum reduction of cost. Okay. Because you have to do the increase. See, when receivables are increasing, you have to, you will be incurring some cost, right? So minimum, like you are expecting this much minimum, correct? See, when receivables are increasing, you have to take overdraft facility, short-term loan, that point of time to make the payment to your suppliers or run your business. So whatever the cost you're going to incur, okay, so this much return you should at least get so that you can recover those costs also, correct?
Yes. At least a minimum required rate of return.
Yeah, minimum required rate of return. Next. Yeah, next. So company analyzes the people who wants credit and increases the quality of accounts rejected. They want to, they are increases the quality of accounts rejected. What do you mean by this? Increasing the quality of account means the fewer sales will be made. Increases the quality of accounts rejected. Whatever the accounts they have rejected, they want to enhance the quality of that. More and more quality if you enhance, that means you want to give the credit to the best customers only, right?
Yes.
That means fewer sales will be made, correct or wrong? That means you're going more stringent.
Okay.
Understood? See, if there are some customers, 100 customers, when a company analyzes credit applicants and increases the quality of accounts, that means they want to reject many of the people based upon less quality. They want very good quality customers right now. So with that, what they're trying to do, they are trying to give credit to only best customers, correct? So
Okay,
with
yes,
that, what will happen? Fewer sales will be made,
right.
and the company is therefore not trying to maximize sales or increase bad debt losses. So they want to reduce bad debt losses to increase profits.
Profits. Okay.
Less bad debt losses
Increases profit.
and increase profit. Next. After a typical credit sale is made until the firm receives the payment, correct? Average collection of days.
Yes,
You made the sale and you're waiting for the payment.
right.
Ninth question. Tenth is, yeah, first we'll do 10th, then we'll do 9th. The firm is changing its credit terms from net 30 to 2 by 10 net 30. That means first it was 30 days. Now 30 days, but if you make in 10 days, 2%
10 days,
extra discount.
2% discount. Okay.
The least likely effect of the change would be an. If they are making payments early, you will be borrowing less, right?
Short-term borrowing.
Yeah, actually least likely, see, changing credit terms to encourage early payments by the customer increases firm's cash flow and decreases need for short-term borrowing. So least likely.
Okay.
Understood?
Yes. Yes, sir. Got it.
Most likely is they are not going to borrow. Least likely they're going to borrow.
Got it.
Now this last question. Company can increase annual sales by this much if it sells to new riskier group of customers. Uncollectible account expense is expected to be 16% of sales. Collection cost will be 4%. Manufacturing and selling expenses are 75% of sales. Effective tax rate is 38%. If the company accepts this opportunity, its after-tax income will increase by what? See, company is increasing. A company can increase the annual sales by 150, right?
Yes, sir.
Uncollectible amount, uncollectible accounts expense expected to be 16% of sales, and collection
That's
cost is 4%. Okay. Companies manufacturing and selling expenses are 75% of sales. That means out of 100%, if 75% goes for COGM, cost of goods manufactured, 25% goes for gross profit, right? So into
right.
25%
Yes.
is how much? See, and
37,500.
yeah, 37,500, your gross profit is going to increase. Why? Because your sales have increased by 150, right?
Yes, sir. So,
So with this,
the,
yeah, sorry.
no, nothing said that.
Yeah. Now they are going to expect this much people not making money, not paying money. For 150,
Yes.
the bad debts is
16.
going to be 16%. So tell me the amount. 24,000.
Yes, 20,000.
Just a second. Now collection cost is going to be how much? 4%, right? 4%.
6,000.
Yeah. So how much is the net you are getting?
7,500.
Of that you pay 38% taxes. 38 means 62% we need to take, right? Okay, tell me 38% of this. 75. Sorry.
2,850.
After this tax we remove, what is the final amount?
4,650.
So this is your increase in profits. Okay.
Oh. And note it down.
Yeah. Profit after tax. Okay, Samir, we'll continue with the next session. I think probably day after tomorrow I'll take, not tomorrow. Tomorrow I'm taking class for short-term investments in CMA only. I'll tell you to join. Okay.
Okay, sir. Okay.
Yeah, that will be a revision class kind of. Day tomorrow day after tomorrow, if I finish that, this I'll finish in a day, and we'll close this. Then we'll go for next one. What? Pricing.
Yes, sir. Pricing.
Pricing, and this one done. This one also is there.
Corporate reconstruction.
Yeah.
8th and 11th is.
Okay, this two we will target. Fine. Okay, okay, Samir. Thank you.
Thank you.
Thank you.